Hey, welcome back. With gold recently reaching new all-time highs, I believe gold mining stocks still offer a lot of potential, especially with the price of gold still having some room to go up in the near future. I don't want to repeat myself again, but simply put, rate cuts will make gold a more attractive option. When the risk-free US treasuries pay you 4, 5, 6% compared to nothing and maybe inflation protection from gold, big money goes into that kind of asset. But when they get back to 1, 2, 3%, gold becomes a much more attractive option, not to mention that the longer we see high rates, the better it can be for gold. That's because the role of high interest rates is to slow down the economy, but if there isn't a soft landing, the economy can get into a recession. On the other hand, when the rates are cut, the value of the dollar goes down, meaning that assets, gold included, would be worth more dollars. If you look at other commodity producers, including silver, which are 50 to 80% gold companies, they tend to be at relatively high valuations, while the traditional gold miners are still well below them. This, let's say, discrepancy is pretty much unique to gold mining companies. You can argue that they aren't as profitable today, but a significant amount of silver companies are not only not as profitable, but actually have a negative cash flow. We can see a trend in the industry. Production costs generally went up due to inflation, high rates and other elements. That's actually good for gold because it means that if it falls to a certain level, there is a safety net that basically keeps it from crashing too much. If it goes to 1.2 thousand, for example, the supply would decrease so much that it's very likely to see the price jump up again. Again, it's all about supply and demand over time. At 1.2 thousand per ounce, the supply would drop by like 60-70%, which is simply not sustainable. You know, back in 2016, 17, 20, 1.2 thousand was okay given the production cost, but today that's a very different story. Something that's relatively unique to gold is that a big chunk of the demand comes from investing and similar things. This isn't the same as normal demand because it doesn't necessarily have some financial logic behind it. You know, with a gold ring or a necklace, for example, if you normally sell it for, let's say, $100, you simply can't spend 200 on the gold. If you then ask for 300, people may not buy it. That's demand based on financials and budgets and consumer spending and so on. With investing, however, that's not the case. If anything, if gold somehow goes to 5,000 per ounce, the market might be even more interested. Then you have fear of missing out and speculation and hysteria and stuff like that have nothing to do with the real value. This creates volatility, which in my opinion is a good thing. That way you have kind of a bottom price because if it falls to 1.3 thousand, for example, half of the mines on the planet won't produce it because it wouldn't be profitable. Meanwhile, the upside is theoretically infinite. And another consequence of this, gold prices don't depend too much on China, although they depend on banks and other institutions that can manipulate it. Again, they are in a unique spot as a commodity. Normally, with metals like iron or copper, you have 40, 50 or even up to 80% of the demand coming from China, which is not the case for gold. To begin with Barrick, they are the second largest gold miner on the planet by production. The all-in sustaining cost went up lately, but it's still relatively low, as you're about to see, especially given the size. The production cost went up significantly in Q1, although that's generally a seasonal thing as they do some maintenance in that period. They see the production ramping up again later this year and delivering the expected results. Again, this is a common trend in the industry, but a majority of gold companies should still have a very good margin at the current prices. They have gold and copper mines in the Americas, Africa and South Asia. Copper and gold are pretty much opposites, but they should both benefit from a cut in interest rates. Given the current market with a lot of acquisitions lately, I wouldn't be surprised to see Barrick merging with a smaller company. That wouldn't be terrible, as the smaller ones tend to have a better production cost. Even with higher capex, they can make an average of around 1.5 billion in cash flows, but in a very good year, they have the potential to make even more than 3 billion. In a, let's say, perfect year with full production, no big maintenance or capex, at the current price of gold, I think they can even break over 4 billion. For a market cap of 30 billion, that's basically 10 times what they could make in a good year, which is relatively cheap. This is, again, common among gold companies, as you are about to see. Financially, they are in a good position, with the current assets being many times higher than the current liabilities. Overall, the total assets are more than 3 times bigger than the total liabilities, and they don't have a lot of debt. So a good financial shape, and you get like 32 billion in equity, which is above the market cap, so the price to book is less than 1. Again, given the performance of the commodity, that's very cheap. Silver companies, for example, are at a ratio of like 2, which would be relatively justified given the current economy. This relative cheapness is again pretty unique. I mean, think about it, not having 20% of the revenue coming from silver and the rest from gold and a couple of other metals justifies them being at half the price. They have a dividend policy based on the net cash position. This means that if they get a couple of good years, that can improve the balance sheet and fuel high dividends for 3, 4, 5 years, or maybe enough to get to some good times again. This kind of policy allows them to focus on the company, and then, when things are great, they also pay a potentially nice dividend. If you buy them at 10 or 12, for example, you can lock in a predictable 8.3 to even 10% dividend, which is definitely much more attractive than gold itself. Plus the potential 3-4x that they can grow during the upside and the buybacks. So, like any cyclical company, ideally I buy them during the downside, but given the unusual environment and upcoming catalyst, I think even a price below 20 should be pretty good. Now, a point that someone made in the comments before is about them issuing shares. I know from what video he got it. Normally, Barrick and the majority of gold companies don't issue a significant amount of shares on a regular basis. They do it, however, to fund mergers and acquisitions. That kind of dilution is very different. Yes, they issue, let's say, 20% of the market cap, but they also add like 15, 20, 25% to the balance sheet. This means that even though there are more now, a share gets you the same amount of the company, so you aren't actually diluted in the true meaning of the word. Outside of that, Barrick at least does buybacks. You know, generally, this kind of thing is something that you should see in relation to what the company does. Overall, I like Barrick and they are my main exposure to gold. I think a mix of 2-3 gold companies is the ideal way for me. They are in a good financial shape, not a lot of debt, good assets, acceptable production cost and a good dividend policy. Even though they went up a bit lately, I think they still have a lot of potential, especially if gold prices remain high for a longer time. Now Newmont, this is the number 1 gold producer on the planet, also mining some copper like Barrick. They have mines in Africa, the Americas and Australia, including about 10 that are considered tier 1, which is basically the best type of mine. Again, you get some gold, copper, silver, zinc, so overall a good mix of commodities that's pretty common with gold companies. They recently had a merger with Newcrest, an Australian miner with a low production cost that should add about 1 billion on average to the cash flow. Again, they issued shares, but it's not really the traditional dilution. You know, doing this is much better than getting like 20 billion in debt to fund it. With Newcrest, they can probably make around 5 billion in a very good year given the current price of gold. For a 45 to 50 billion market cap, that's a very similar ratio to Barrick. What I don't like about them is the way they present the company, which is a bit dishonest. When you open any recent presentation, pretty much the first slide you see, there is that 1.2 thousand all-in sustaining cost. That's a 5-year average, meaning even before the pandemic. In reality, it's over 1.4 thousand. Still, at the current price of gold, that's a very good margin, but the way they approach it is a bit bad. Why not just say, yeah, we know it's high, this is why, and we are working on reducing it, which they actually do. About that, they recently said that they want to sell some of the more expensive mines and focus on the tier 1 portfolio, which indeed is actually very good. They see about $500 million in synergies, plus another half in productivity improvements. If they manage to do that by 2025 as they plan, they could even make as much as $6 billion in cash flows. Then, the potential for dividends and buybacks would be very impressive. Financially, they are in a good shape, with the current assets being above the current liabilities. Overall, the total assets are well above the total liabilities, and there is about 29 billion in equity. Notice that the equity is similar to Barrick's, but the market cap is over 60% higher, so Barrick is definitely better from this point of view. The maturities of the debt shouldn't be an issue, by the way. They have a base dividend of $1, meaning around 2.3%, and 1 billion in buybacks, meaning another roughly 2.5%. They used to provide a guidance to get an idea about the dividend based on the price of gold, but they don't show it anymore. They'd have to rethink it given the Newcrest merger and the higher price of gold. It isn't binding, but again, why just pretend it never existed when you can say we issued shares, gold is high, so give us a bit of time to rebalance and then we can get back to it. Again, they give this feeling of dishonesty, trying to present everything as perfect. Overall, between the two I prefer Barrick, but they aren't a terrible pick either. Good financials, good tier 1 assets, and if they focus on rebalancing the portfolio and saving some money, the production cost and the cash flow should also be okay. I have a very little bit of Newmont that I bought a couple of years ago, and I don't think the current price is bad. Like Barrick, they can probably offer a 2, maybe even 3x from the current price depending on the price of gold. Still, I prefer Barrick thanks to the financials and the production cost. Now, Agnico, this is the number 3 producer on the planet, being able to mine around 3.5 million ounces, being at the, let's say, higher end of the medium-sized gold companies. What's very attractive is the very low all-in sustaining cost. They are basically 2.5 small and medium miners that recently got together into a very competitive company. 2 years ago they had a merger with Kirkland, and a year ago they bought Yamana's Canadian assets, so obviously there is going to be a lot of growth and we can compare it to 2020. If during the good times they get let's say 400 million in cash flows from Yamana and 750 million from Kirkland, they could probably make around 1.5 to 2 billion together in good times. They seem to be on track to achieve it this year. It's just a rough estimation, but it would put them at a price to free cash flow ratio of around 20, which isn't the cheapest, but it's something that I would call fair in the current environment. I would expect this from a majority of the industry. Financially, they are doing okay, with the current assets covering the current liabilities and a good chunk of the long-term debt. The total assets cover the total liabilities well, leaving you with around 19.4 billion in equity. However, that's 50% below the market cap, and comparing them to Barrick again, they are more expensive from this point of view. Next year will come with about 700 million in debt repayments, but other than that there shouldn't be an issue. The problem, however, is the dividend. They currently have been paying one since 1983 and they seem to keep increasing it in time. As they say, every $100 change per ounce of gold should generate around 250 million in cash flows. Sure, it's okay now, but what if gold gets back to, let's say, 1.8 thousand per ounce? That's over $1 billion in cash flows gone, meaning that paying 800 million as a dividend becomes unsustainable, not to mention debt and interest payments. And then you have the issues. What do you sacrifice, the balance sheet, or cut it and risk having a crash? And it matters because if they keep having this relatively high valuation, that puts them in a very good spot to do other mergers and acquisitions. When your stocks are valued like 2 times above the average, you are basically paying $1 to buy 2. And they can even afford giving a nice premium and would still win. So, on the other hand, the longer we see such gold prices, the even better it is for Agnico in particular. A couple of years at the current prices would be enough time to improve the balance sheet significantly. Meanwhile, they can use the stock to buy other gold companies, especially if the others remain at a lower valuation. So, overall they are more expensive, but in the current environment and given the company's history, that might actually be an advantage. I really wish the dividend wasn't such a burden. With a higher valuation usually comes a lower dividend. Almost $1 billion for a currently pretty meaningless yield isn't worth the trouble, but it isn't the time to cut it either. Still, a good company with nice financials and among the best all-in sustaining costs in the bigger companies. I think they are an even bigger bet on the price of gold because if it falls, then they would have double the trouble. But if it doesn't, then it's probably a very good investment. Now, Kinross, this is a medium-sized miner producing around 2 million ounces. In the previous video I looked into Ashanti and goldfields as well, but they really aren't that interesting. Kinross, on the other hand, was much better, so I decided to do a follow-up. They expect the all-in sustaining cost to be around 1.36 thousand this year, which is, as we saw, pretty much the average of the industry. We can see the main factors behind the higher production cost and capex in general: power, oil and gas, and labor. This kind of cost could go down, but don't expect it to be too much. It's very likely that the new low in the all-in sustaining cost will be in the 1200s now, which half a decade ago was very high. After going up more than 50% since a few months ago, the market cap is around 10 billion. That's pretty much 10 times the cash flow from 2020, so they are still in line with the cheaper options. They have mines and projects in the Americas and one in Africa, with a majority of the production coming from the project in Africa and the one in Brazil. They also talk about the valuation being among the lower ones, but more on that in a bit. Keep in mind that this is after they went up significantly recently. There are a bunch of projects that they are advancing, including a new mine in Alaska that's expected to start production around Q3. The current assets cover the current liabilities and overall they don't have a lot of debt. There is about 6.2 billion in equity on a market cap of 9.5 to 10 billion, so from this point of view they aren't that cheap anymore. They have a 1 billion debt repayment next year, but overall the debt is not an issue. The dividend isn't attractive, but it's also just a small part of the cash flow. If they want to pay out, let's say, half, then this can be a 4, 5, 6% yield. I call them a relative buy in early March, but now after a 60-70% rise, they are a bit on the expensive side. You know, balancing the risk and reward, they don't seem that good anymore. It's a good company with potential, but not such an attractive investment anymore given the rest of the market. The thing is, Kinross and Agnico performed as they should in such an environment, the others are the unusual cases. Now Alamos, this is a smaller miner that's able to produce around 500,000 ounces. They recently plan to buy another miner with assets in North America, growing the production to 630,000. In the long term, with a couple of new mines, they expect the production to reach around 800,000 ounces. The all-in sustaining cost is low, around 1.2 thousand, and they expect it to drop even more. I would take that with a grain of salt, especially since it's North America, meaning that labor, oil, power and so on aren't that cheap. They show the cost structure and, you know, what do you cut from here? The labor, the maintenance? But if they keep doing this kind of strategic purchases that can result in synergies, they could produce at a very good price. Still, producing at 1.2 thousand, which nowadays is low even in Africa, in North America is an achievement. They very recently had some good exploration results near already existing infrastructure, which can be very beneficial. The current assets cover the current liabilities, and what's very interesting is that they have zero debt. That puts them in a position where they can adapt to anything that would happen. If there is a recession or some tough times, for example, they wouldn't have to worry about interest and debt repayments, and they can issue debt to buy a competitor or a mine or develop something. So this lack of debt today can be a potential catalyst if they decide to get some in the future, because debt in this case means growth. The equity is close to 3 billion, so less than half of the market cap, which isn't great. But again, that places them in a position where they can use the stock to develop the company. With higher capex and 45 million in taxes to Mexico, they made a free cash flow of 24 million in Q1. Without all of that, at the current prices and production, they can probably make around 300 million. You know, 10 times that much is basically the value of the equity, which, given the quality and potential to grow, would be a good price for me. They need around 100 million in sustaining capex, meaning that they spend around 250 million on development, which is really good. They pay a very small dividend, which I think they better stop and just focus on the growth. By the looks of it, this is a potential acquisition target for sure. It's too bad the price went up so much, but on the bright side, same as Agnico, that's very good if they want to do mergers and acquisitions. You know, quality-wise, this is probably the best company in today's video, but that comes with a price. A majority of mines in North America, low production cost, very good financials, potential to grow, low capex requirements. It's an ideal small mining company. The thing is, growing production through exploration takes ages and companies often don't have that much. If you are a bigger company and want to grow the production by 6 to 800,000 ounces at very low production costs and in North America, this can be a viable option. I think it would be okay for Agnico since they are valued relatively the same. Even if they pay 8 billion, they basically increase the production by up to 25% at the cost of diluting around 25% of the company. And again, high quality, low cost mines in North America, not any kind of mines. Now B2Gold, this is a smaller company with 4 operating mines and a couple of projects in development making around 1 million ounces. The all-in sustaining cost was around 1.2 thousand last year and it's expected to be around 1.4 thousand this year due to some investments that should significantly increase the production. It's probably a good time to do it since even at 1.4 thousand the profit is very high. In a very good year and even recently, they were able to make around 4 to 600 million, putting them at a ratio of around 7. If the market gets the miners to 15 or 20, this can easily be a 2 or 3x, which is very similar to the high from 2020. To be fair, with normal capex and high gold prices, they can probably make even as much as 800 million. But gold barely broke 2000 back then, not 2.3 or 2.4 like today, so there could be potential for even more. And generally, the smaller companies tend to have a lower production cost and much more potential to grow. One reason is the lack of volume, and again, in the short term, stocks are all about supply and demand. I remember back in 2019, a small gold miner that I had went up like 10-15% per week and tripled in like 3 months. Financially, they are in a very good position, with the 1 billion in current assets being almost enough to cover all the liabilities. That means there is like 3.9 billion in equity traded at around 3.6 billion, so a bit below it. So pretty much the cheapest from any point of view so far. The dividend has been relatively high for a while, around 5.7%, meaning roughly 210 million, which is very sustainable. That's the advantage of a low valuation. Even half of the cash flow can be a very significant dividend. Now, the issue is, yes, they have a low production cost, but half of it comes from the mine in Mali. Of course you have a low production cost in Africa, but that unfortunately comes with political risk. You probably know about the military junta and the coup d'etats, yes, plural. You know, outside of that, everything is very good, but it's definitely a risk you have to keep in mind. It's really a shame, because otherwise this would have been a very good investment. Very good financials, low production cost, cheap, but with a downside. Now, all of them have their ups and downs, so it's ultimately about the risk and reward you are willing to take. Sure, smaller ones tend to have a better potential, plus being acquisition targets, but it's often at a higher risk because usually the production is very dependent on a couple of mines in risky jurisdictions. So overall there are quite a few interesting companies. You can see a summary on the screen. Again, I like and I own some Barrick, but a mixture of 2-3 companies is in my opinion the best approach. It depends on the level of risk you prefer, but overall they should all benefit greatly from a rise in the price of gold. Or even if it remains at the current level, it can still be very good. I think that when the rates are cut, gold can probably break over 2,500, which could be very good for the companies. I believe gold mining stocks don't reflect the potential of the commodity in the current environment, and there is a good chance to see this gap close in time. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.